Well, back with us on the program is Brian Belski. He's the chief investment strategist for Oppenheimer, who has been telling us that industrial and technology stocks are the best bet and that we are on the edge of the next great bull market. Brian, great to have you back.
Good morning.
John and Dominic, of course, here as well. However, we just ran a headline here that the 10-year yield has now fallen below 3% since this lowest since December. Come on. Doesn't this undermine a case for a bull market?
No. Not from the longer term perspective. We've been very consistent with respect to our message that we were going to see single-digit returns this year. Positive is still positive. Much less positive than the rest of our brethren in the strategist world that are exceedingly they're exceedingly bullish, we think. And we are not surprised to see these weak employment numbers. In fact, we've been talking about them for a while. We're not surprised to see bond yields dip below 3%. I think one of the things we talked about last time we were here is that we've seen the reemergence of bond inflows from investors. They're buying bond funds again because they're scared, because the budget talk is kitchen table fodder now. Our kids are talking about it. Our neighbors are talking about it. I'm getting questions from neighbors about what this debt limit means and things like this. So, you know, we need to, as a country, fix the budget issues first, and then move on to build more security in terms of investing again, and then move on to some of these other issues. So we're not surprised at all in terms of the kind of pullback we think we're going to get.
Well, I mean, Brian, one of the things that we talk about constantly is this idea that people are maybe moving back into bond funds a little bit now. But how much is this a short-lived kind of event here? Or is this something that we're going to say, you know what, 3 months, 6 months, 9 months from now, we're still going to see a bit of, you know, that stagnant activity, stocks maybe not moving much of anywhere here?
Well, around a year ago, the common theme was soft patch, or many people were talking about a double dip. We are clearly not in the double dip camp. We think we're seeing a classic soft patch here as things kind of slow down. And again, for investors, this should come as no surprise, especially if you heard and listened to first quarter earnings reports. Yes, earnings were great, cash flow's great, balance sheets are great, but CEOs are not putting cash to work through employment. Period. And that needs to be the major theme coming out of this to get the economy going again.
One of the groups that we've talked a lot about with you are healthcare stocks because they've been some of the best performers this year. You've described them as the group that people are renting for now because of this uncertainty. Yep. To Dom's point, do they rent them a little bit longer than you might have thought because of the economic data that we're getting now?
Well, it could very well be a quarter or two event, right? But we still think from a longer-term perspective, there's some structural issues facing healthcare, namely growth proposals, especially in the big drugs. But in our portfolios that we manage for Oppenheimer clients and things that we talk about to our institutional clients, we continue to favor more of the higher growth areas of healthcare, meaning biotech, life sciences, some devices. The drugs are great for dividend growth, and we own some of those names in our dividend growth portfolios. But aside from that, I think it's very difficult to paint a broad brush on healthcare right now.
Brian, you've stuck with these themes for quite some time. Right. What would make you change, either upgrade or downgrade your forecast?
Well, first and foremost, we do not want to see QE3. We do not want to see QE3. I think QE3 is a short-term event which will cause the markets to go higher because investors the last 10 years have become so reliant on cheap money, low interest rates. We think that only prolongs the inevitable when the Fed has to eventually sell these securities that they've been buying. That's number one. We become excessively bearish if the Fed goes to QE3 after the big move, because we'll see a big move after QE3, and then I think the market will fade for several months after that. So we'll become bearish after the QE3 event. The other thing, too, is if on a near-term basis, if we start to see negative employment growth for a couple of months in a row, that would not be good. I think it would shock the system, and investors would pour even more money into bonds. The inevitability, folks, is that the next longer-term move in our collective careers is higher interest rates, period. Again. And so all this short-term event going back into bonds is just, again, prolonging the inevitability of higher interest rates and better economies and higher inflation.
And that
things
unwind
like that.
in the bond markets that you've been waiting for.
Yep.